President Biden's campaign promise to push through student loan forgiveness is bad public policy. Thankfully, the Supreme Court slapped down President Biden's $400 billion undemocratic vote-buying executive action to forgive student loans as unconstitutional. Student loan repayments will commence in October of this year, since being paused in March of 2020. Student loan repayments were paused due to the government-imposed lockdowns during the COVID scare. The President knew his order was unconstitutional. He had said so on TV. Speaker of the House Nancy Pelosi knew it was unconstitutional and said so on TV, and I quote, "People think that the President of the United States has the power for debt forgiveness. He does not. He can postpone, he can delay, but he does not have that power. That has to be an act of Congress." It was an effort to buy votes in the midterm elections, and the continued effort is to buy votes in 2024. Who doesn't love debt relief? However, there is a legal process already established. The President's executive action allowed up for $20,000 in student loan relief, $10,000 for federal loans, and $10,000 for Pell Grants. The income thresholds revealed the evidence that the giveaway was not just for the downtrodden, low-income Americans, but for the middle, upper class, and wealthy as well. An individual was eligible for relief with incomes up to $125,000, and for couples up to $250,000. I wonder who came up with these levels. $250,000 for a couple is good living, even in New York City. They should be able to manage student loan repayments with that income. Even the $125,000 level of income is high and should allow for loan repayments. Apart from living in New York City, Boston, LA, etc., there's 3 or 4 places around the country, maybe not so. But the level of income threshold should be much lower, below $100,000 for sure. Both the U.S. Senate and the House voted to block President's actions, with Democrats supporting Republicans. Of course, Joe said he would veto the legislation. He needs votes in 2024. The President overstepped his authority. Why? Well, the claim is to protect borrowers from defaulting. This, rather than allowing individuals' credit score to fall, instead, let's just pass the burden on to taxpayers that would include hundreds of millions who didn't choose to take out loans to go to college, or did so and paid them back. The Democrats, led by President Biden, are not giving up. The President already has a new plan in place, probably because the President knew his executive action was unconstitutional. The new plan, as always, has a catchy acronym: SAVE, S-A-V-E, Saving on Valuable Education. Can we stop there for a second? Valuable education? That's funny. My guess is many of those struggling to pay back their student loans didn't get a valuable education, one that could lead to a job that pays an income to allow for loan repayment. In any event, the President is determined to follow through on a very expensive campaign promise to reduce the burden of student debt. SAVE is an income-driven policy that limits borrowers' monthly payments to 5% for discretionary income, and outright loan forgiveness for those with less than a $12,000 balance who have been making regular payments for at least 10 years. 10-year cost estimates for the taxpayers range from $138 billion to $471 billion, with the Congressional Budget Office, the CBO, estimating the cost at $230 billion. Let's shred contract law for votes. Let's add more debt for votes. Let's ignore the Constitution for votes. The orange man must not win. Or is it all for the good of the economy? If you don't have to pay back your loans, you can increase your current consumption now, buy more stuff, increase GDP, and get more votes. In 1965, the federal government started guaranteeing student loans by banks and nonprofit lenders. For the next 45 years, student loan growth was stable and low. Then came President Clinton and the beginning of the post-secondary education bubble, with his efforts to reduce borrowing costs and expand money available for colleges. He expanded student aid from $22 billion per year to $50 billion per year, with a litany of other incentives to increase college enrollments for lower-income families. President Bush stepped in this direction as well to help out low-income students just before the 2004 elections. I wonder. Then came President Obama, and the whole game changed. By pushing, passing, and signing the Education Reconciliation Act of 2010, the post-secondary education bubble expanded sharply, and outstanding student loan balances revealed the results. The federal government would now be providing student loan money directly with much more favorable interest rate and repayment options. The data chart from Fred reveals the damage caused by President Obama. You can see in the chart the very obvious inflection points when Bill Clinton started his efforts in the 1990s, and then very obviously in 2010, you can see the change in the slope of the line when President Obama passed the Education Reconciliation Act of 2010. The moral hazard for students and institutions rose dramatically. Higher enrollment, the college building boom, the tuition boom, the room and board boom, and more debt are the beginning of the basis for the argument there is too much student debt, and so debt forgiveness is required. The SAVE Act will also have to be challenged and halted. We cannot do this. This is bad public policy. There are legal paths for borrowers to manage their financial risks. And that is the key, managing financial risk. That is what begins the moment a student signs on the dotted line for a student loan or any loan. They have now agreed to take on financial risk, and it's their responsibility to manage it. If they can't, they have risked the credit rating, their lifestyle, their family relationships, and their health and well-being. Horrible to be sure. Those are the risks. The federal government has engendered significant moral hazard into post-secondary education for both students and the institutions, taking risks for which someone else is responsible, i.e. the taxpayer. Students take on debt with some expectations. If things don't go well, they're off the hook for their debt. For institutions, expand their facilities and hiring and program offerings will pay by student loans, which the taxpayer will be liable, ensuring continued high level of enrollment and salaries for faculty and, most importantly, administrators. Let's make a note here. I'm using the word student with respect to taking out loans. We recognize, of course, oftentimes parents take out these loans. So student, parent, the risks apply either way. So the question is, why can't we have student loan forgiveness as proposed by President Biden? Number one, it's wildly unfair for all those who have already paid back their student loans or chose not to go to college at all due to the cost concerns. Number two, the moral hazard is high and evident for all to see. A key element of free market capitalism is contract law. Contracts are enforced by governments. Number three, it is expensive. If you haven't noticed, the U.S. federal government is $33 trillion in debt. Our yearly federal budget deficits reach over $1 trillion a year. We do not have the money for this. Number four is inflationary in an already inflationary environment. Number five is a subsidy to post-secondary institutions and highly paid administrators that has been established over the past 15 years. Moreover, those subsidies accrue to the worst of college institutions, the worst of academic programs, the worst of academic outcomes. Not one student or parent was forced to take out a student loan. They knew what they were doing when they signed. They knew it had to be paid back. They knew picking the wrong college or major would result in low lifetime earnings. They knew if they weren't good students, their job prospects would diminish and negatively impact their earnings potential. They knew the risk. Number seven, the program is regressive in that it reduces the debt burden of millions of wealthy households and puts a higher tax burden on poorer households. Number eight, what will students do who are taking out loans this summer for school starting this September? Will they get a loan forgiveness in 4 years? Will there be another loan forgiveness in 10 years? Are we going to have periodic loan forgiveness? What about the students that are freshmen in high school today and take out loans in 4 years to go to college? Will their loans be forgiven? Will college be for free? And number nine, it is a simple political ploy to buy votes to stay in power. The lending process is a key element in the functioning of the macroeconomy. Through the lending process, we can expand personal consumption expenditures and gross private domestic investment. When we take out loans, the money supply rises and the consumption investment rise, increasing gross domestic product. The opposite is true. When we pay back loans, the money supply falls and consumption and investment fall, decreasing gross domestic product. President Biden set expectations for borrowers knowing his efforts would fail. In the legal world, this is called detrimental reliance. Reasonable reliance on the promise of another to act as promised, and the failure to fulfill promise results in the harm to a person that was reasonably foreseeable. Sadly, the federal government cannot be sued for this. But voters, parents, or students with loans they wrongly expected to be forgiven can switch their vote from the guy that duped them. Say no to student loan forgiveness and always try to buy American.